Welcome to slide pack 3 of the financial modeling program. In this slide pack, we will be talking about developing financial projections. So before you get into projecting financials, what you should first do is compile historical financial statements for the income statement, the balance sheet, and the statement of cash flows. Now, ideally, you want to do this for at least the past 3 fiscal years and the past 4 quarters. What this will do is it'll tell you what line items really impact the running of this business from the income statement perspective, what matters on the balance sheet, what are the ratios of the inventory, the working capital, the debt, etc. What is the cash that's being generated from your various activities? And the historicals will also tell you what one-off expenses are or what normal capital expenditures are required to maintain your business. What is the growth in revenue? How have the margins been changing over time? And in general, it'll give you a sense of how predictable or not the business is. And this historical information will then give you a foundation upon which you'd be able to intelligently project out financial statements for the next 5 years. When you're dealing with a public company, in today's world, fortunately, financial statements are fairly easily available under the investor relations section of the company's website, or every public company is required to file its financials or any other material statement with the SEC, and you can get that information from the SEC's website at the link that's on this slide. I would not recommend that you use Yahoo Finance or Google Finance because these might not always be updated and might not always be accurate or might not often have the level of line item detail that you'd find in the original company's financial statements. Now, what we have here is just a very simple example of financials for fiscal years 2006, 2007, 2008, 2009 for a company. And then what we have is quarterly historical data for fiscal year 2010. And so one can sort of look for trends on how things change on a year-by-year basis, and one can also look for seasonality on a quarter-to-quarter basis. So oftentimes, sales may be higher in, say, the second quarter versus the first quarter. Or for retailers, sales in the Thanksgiving, Christmas time are often more robust than they are, let's say, in the second quarter of the year. You can also look at things like how has the net income margin been changing over time. So what, for example, if you look at the bottom line here, you'll see that the net income was 19.6% for 2006. It went up to 21%, but then it came down to 17%, and then it went back up on a quarterly basis. So just going through historical financials gives you a fairly good sense of what has been happening at this company and gives you the foundation on which you can project future financials. Once you've developed the income statement, the balance sheet, and the cash flow historically, take the income statement and develop what's called a common size income statement. What this basically does is it looks at every single line item in the income statement as a percentage of revenue for that period. So it tells you what the gross margin is, which is essentially the gross profit divided by the revenue. It gives you the operating margin, which is essentially the operating income divided by the margin. It gives you the net margin, which is the net income after taxes and everything, divided by revenue. So this essentially gives you a sense of what percent of your revenue is getting used up by the various buckets of operations, taxes, investment, etc. within your company. And once you have this common size, you can then selectively pick out certain percentages that you can multiply to your projected revenue to get your future projected income statements. Now, all we have here is a sample common size of the income statement you'd seen a couple of slides back. So for example, if you look at the column under fiscal 2006, you'll see that product sales made up 84% of revenue and services made up 16% of revenue. You can also correspondingly see that the cost of sales was 28.5% of revenue for product, but only 5.7% for services. And you can also see items like R&D. 14.3% of your revenue was spent on R&D in 2006. And that number sort of varied between 14.3 down to about 12.8, back up to 14. So you get a sense of the fact that the company is spending somewhere between 13 and 14% on R&D. Likewise, you can see that the company spends roughly about 21 to 22 to 23% on sales and marketing, and so on. And at the bottom, again, you can see that the net income is roughly in the 17 to 21% range. So when you make your projections, you've got to make sure that your projections are smoothly consistent with what has happened in the past. Now, another advantage of having historical financials is that you can then estimate growth going forward by looking at what happened in terms of year-to-year or quarter-to-quarter growth in the past or income increases in the past. Now, your revenue for 2010 divided by your revenue for 2009, if you take that ratio and subtract 1, you will get the growth or the drop in revenue that happened from 2009 to 2010. And so once you have a sense of whether the company is growing at a 2% top line rate or a 5% or a 20% rate, you can then realistically sort of carry that forward in your projections. Now, beyond studying historical financials, it's also very important that you study what is actually going on in the business that you're trying to project out. Get a sense of how strong this company is within its industry, how the industry is growing over time, and what the specific prospects are for the company that you're modeling. Once you have all of this together, you will be in a fairly strong position to project the revenue going forward, and using the common size, you'd be able to project how your income statement is going to look going forward. Now, projecting the balance sheet is not as easy or as direct as projecting your income statement. There are various ratios and parameters that you need to understand and calculate before you get comfortable with balance sheet projections. One of these ratios is days of sales outstanding. A lot of companies sell products on credit where they do not receive cash payment, but they get payment 30 days after the sale or sometimes 45 days after the sale, depending on the terms that you have with your clients. And just a side note here, if you have a 60-day payment term with your client, chances are you need their money, perhaps as you perceive it, more than they need your product. And that typically isn't an indication of management strength. Management needs to push for a quicker turnaround on payments. So back to days of sales outstanding, or DSO. DSO is a ratio of the accounts receivable divided by the daily dollar sales in that period. So let's just say you have an accounts receivable balance of 800 that your various customers need to pay to you, and that you had credit sales of $1,000 over the past 90 days. So the average sales per day works out to 1,000 divided by 90, which is roughly about $11 per day. But you have $800 outstanding. So when you divide 800 divided by 11.11 gives you the days of sales outstanding, which in this case is 72 days. So what this tells us is that it will take roughly 72 days before you collect your outstanding receivables. So when you look at the revenue that happens in a quarter and you want to make an fairly reasonable estimate of what the accounts receivable is going to be, you can factor your days of sales outstanding to get a sense of what the AR is going to be. Now, typically, an increase in the days of sales outstanding is not a good thing. As trends go, you want to look for a company where the DSO number is declining, which basically means that the company is good at collecting from its customers. The other good thing about a DSO is that you can compare your company's DSO with perhaps your competition's DSO. And if your DSO is higher than the competition, then they likely have a leg up, or they are running their business more efficiently than you are. And so oftentimes you can set a target and say that I am going to get my company's DSOs down to what the average is for my industry. Or if you are doing very well on DSOs, you can go back to management and say, look, our DSOs are much lower than our competition, and we need to sort of hold the DSOs low. And DSOs are always good because what they mean is that you're good at collecting cash, and cash is always king when you run a business. Another ratio, inventory turnover. Inventory turnover is the cost of goods sold from the income statement divided by the inventory on the balance sheet. What this basically tells you is how quickly you turn over the inventory that you have. And a higher turnover rate is always better than a lower turnover rate. So you must calculate the inventory turnover historically and use that to project out your balance sheet. Other parameters, working capital. Working capital is your current assets minus current liabilities, and basically gives you a sense of whether you've got enough money to run your day-to-day operations. Because realize, you may have to pay out cash today to take certain supplies, but you may not get payments till another 30 days or 60 days after you sell the product. So working capital is a good parameter to understand, and the more working capital you have, the better. Now another term is operating working capital, which basically is your current assets less your cash minus your current liabilities less short-term debt. So this basically tells you that if you put your cash aside, what is your position in terms of managing your assets and liabilities so you have enough liquidity to run your company without running into trouble. Another important ratio is the current ratio, which is the current assets divided by the current liabilities. And what you really want to have is more current assets than current liabilities. So definitely shoot for a ratio that's greater than 1 and higher if you can. The quick ratio is a variation on the current ratio, and all it does is it subtracts the inventory from your current assets and divides it by the current liabilities. And the reason that the inventory is taken out is because inventory cannot sell very quickly and cannot very easily be converted to cash. And so if you do convert your inventory to cash right away, chances are you're giving it away at less than what you might if you sell it if you're patient. So inventory is a less liquid item that's taken out to arrive at the quick ratio, which gives you a slightly better picture on how well your current assets cover your various current liabilities. Payable days is the accounts payable divided by the cost of goods sold, and it essentially gives someone a sense of how much time you have before you can pay off your suppliers, or how favorable your terms are on payments that you need to make to your suppliers. And the longer you can hold off on paying your suppliers, the better, because that means you've got that cash that you can either deploy for your operations or can invest and earn interest on. And so higher payable days is a good thing. Fixed asset turnover measures how productively you're using the assets in your company. So the ratio is sales divided by net fixed assets. Another number is asset turnover, which is sales divided by fixed assets. Both these numbers, the higher the better, which means that you're more productively utilizing the assets that your company has. Now, the ratios on this page are relatively simple. There's the gross margin, which is your gross profit divided by the revenue. There's the EBIT margin, which is your EBIT divided by revenue, and this is also called the operating margin. There's EBITDA, which is a proxy for cash flow divided by revenue. The net margin is the net income divided by revenue as a percentage. All of these are as a percentage. Return on equity is your earnings divided by the average equity that you've held in the period. Return on assets, likewise, is a percentage of the earnings divided by the average assets through that period. Now, other important ratios include debt by equity, debt by EBITDA. And debt by EBITDA is a fairly important ratio because it tells you whether your cash flow is enough to pay off your debt. You also have net debt by EBITDA. Net debt is simply debt minus the cash that you have within the company at that point in time. Times interest earned basically is a ratio of your EBIT to the interest expense. And it gives you a sense of how comfortably your cash flows can be used to pay off interest expenses and still have enough left over to comfortably operate the company. If you're running your business more conservatively, what you'd like to look at is the EBITDA less the capital expenses that you need to routinely run your company divided by the interest. So this is just a slightly more conservative measure on making sure that you're not paying off interest and compromising on servicing your equipment or upgrading routine parts and compromising your business. So all of these are very good measures to understand and calculate for your company. What we have on this slide are basically examples of a sample company and its various asset line items and the assumptions on the right hand side that have been made in making balance sheet projections. So there's days of sales outstanding, there's inventory turns, there are certain line items such as prepaid assets that are a percentage of sales. There are furniture and fixtures that are held constant. There's depreciation that has assumptions such as useful life or as a percentage of sales. So this is just an example, but you will have to develop specific assumptions for the company that you're modeling based on your understanding of the company's various line items. Likewise, this page talks about assumptions used for liabilities. So for example, accounts payable is held constant as a percentage of sales. Accrued liabilities are held as a constant. And notes payable makes the assumption that no new borrowings have been happening, and so it's an amount that you decide you want to keep constant. For capital stock, there are again assumptions on paid-in capital or retained earnings, which essentially come from the income statement or various other line items. So just make sure you study every line item on the historicals carefully so you can intelligently make assumptions for your balance sheet going forward. For the cash flow statement, fundamentally, your income statement and changes in your balance sheet from this period to from the prior period to this period are what drive the statement of cash flows. For cash from operations, cash from investments, or cash from financing activities. So, armed with assumptions for the income statement, the balance sheet, you will be able to calculate your statement of cash flows and make your various sheets tie well together and balance. Now, do not expect your sheets to balance the first time around, because the balance sheet in particular is slightly tricky and you have to sort of make sure you get over the initial frustration, revisit your assumptions, and get to a point where your balance sheet balances. But rest assured that with practice, you will get very good at this. And with that, we conclude the slide pack 3 on developing financial projections.